Well, welcome everybody to our webinar today. My name is Craig Colley. I will be your host and presenter. And our subject today is 6 things you need to know about the new federal tax law. It's a big item in the news and the largest, most comprehensive piece of tax legislation to be signed into law in almost 30 years. This is part 1 of a 2-part series. This presentation is meant to provide you with an overview of the major provisions of the new law, and we have identified 6 items in the tax law that every person should know about. While this isn't a comprehensive review of the new law, and it does not analyze how it may affect you individually, it's a good starting point to begin thinking about the changes. Once again, my name is Craig Colley. I am CEO founder of Coliday Insurance, Health and Financial, located here in Laguna Niguel, California. We have folks that have come into the webinar from all around the country and actually some places in the world as well. So we want to welcome everyone to the presentation. And I do need to note that this information is educational only. This is not presented as tax or legal advice. If you need help in that area, please consult your tax professional or attorney for tax or legal advice. I'm not a financial advisor. I'm not giving any financial advice as well. But this is something that the information you may gain today, you can take to your tax or attorney, tax professional or attorney, and talk to them about, because that's really what we're trying to do, is give you some education to help you manage your taxation, particularly going towards retirement and how this new law is going to affect you. So let's get started. We're going to try and keep this conversation under 20 minutes, and I think we will be able to do so. If you have questions as we go along, please email them. We will get back to you. We will not be doing a Q&A during this presentation, but we certainly will respond. My contact information will be there at the end of the presentation, or you can also type it into the chat box that you'll see there in your webinar screen. So let's get started. The new law is known as the Tax Cuts and Jobs Act and will take effect the beginning of 2018. The reason I say that is because some of the provisions have actually gone into effect as early as 2017. We'll talk about that a little bit later. But when most people file their taxes in 2019, they will file their taxes under the new tax law. The impact of the new law on each individual and family will differ depending on several factors. For example, size of your family, the amount of income, type of income, and other individual circumstances. So it's important to remember that no 2 tax filers are exactly alike. So the impact the new law will have on each person will differ. There's many provisions in the new tax law that will affect how you file your taxes. We'll cover those in detail in our second portion of this, our second webinar that we'll be talking about a bit later, but today is a comprehensive view. And also we're going to cover a little bit in the upcoming slides. Boy, twister today on my tongue. The individual tax changes are most likely to expire at the end of 2025. So some of these are not forever type taxes, some are permanent, and we'll talk about which ones those are as we move along as well. The cost of this new tax is approximately $1.5 trillion to the federal government, and that's something very interesting to note as well. So let's move on to number 1, personal income tax brackets. As you can see here, we still have the 7 tax brackets in place. If we compare here to 2017 and to 2018, you'll see that the changes at this income level are the same, but for most people in the middle class level, there's a 3% reduction, and as the income grows higher, less and less of a deduction. But here, substantial difference for us in the middle class area, myself included. One thing to note is 3% difference, though, in what you make on your taxes or save with your taxes can be substantial. The other thing to note is when you're looking at minimizing taxation, this is an overview, if your income was somewhere near the 77,000 point and you took an additional dividend that was taxable, or Social Security starts, which can be taxable depending on what your income is, or some other line of revenue that occurs, that may bounce you up into a higher tax bracket, a 10% difference here just by that alone. So we want to look forward when we're thinking about taxes, not in the review mirror. What's going to happen versus what has happened. That's one of the things I want to emphasize, that we try and help you identify going forward, to have that conversation with your tax professional to figure out how to best set that up for yourself. Number 2, personal deduction changes. The new bill nearly doubles the standard deduction. So for a lot of folks that are doing deductions, the question has come up whether they still need to do all their itemized deductions. Well, that's really different for every individual. I can't answer that question, but I can say in general terms that if you didn't have that much that you were deducting, and it was somewhere falling into the difference of 63 versus 12,000 or 12,000 versus 24,000, you may not have to deduct as much because your standard deduction is almost doubled. You can see these numbers are substantial for where they were last year to this year, based upon this chart here. One thing to note is the personal exemption, providing a 4,050 per person deduction, will be going away in 2018. That's something else to note. So personal deductions are substantial changes. Continue on to the next slide. State and local taxes, which is known as SALT, the deduction is capped at $10,000. In the previous years, there was no cap deduction for SALT. This will likely have a greater impact on people in states where there are higher state and local property sales and income taxes. The mortgage interest, another deduction commonly used by homeowners. The key change in this area is the interest that they pay on a mortgage debt up to $1 million. That's going to be capped at $750 under the new law. For example, if you bought a home before December 15th, 2017, you may still fall under the $1 million cap, but going forward, you will not. Medical expenses. The deduction for medical expenses is a commonly used deduction. Under the new law, the taxpayer may deduct medical expenses of over 7.5% of adjusted gross income, which is income minus specific deductions. And for most for most individual tax purposes, the adjusted gross income, or the AGI, is more relevant than gross income. In previous years, the taxpayer was only allowed to deduct medical expenses of 10% of the AGI. The new 7.5 floor applies for 2 years beginning in the year 2017. Expires after 2 years and returns to the previous 10% level. Something else to take advantage of at this point on your taxation. Another conversation to have with your tax professional. So this is a 2-year window on this. Other miscellaneous deductions eliminated. In the previous years, there were deductions for certain miscellaneous expenses that were more than 2% of the AGI, such as investments, fees, expenses, etc. Under the new law, that deduction has been eliminated. Number 3, our third item, there have been some key changes to the child tax credit. The changes are particularly important for families with young children or other dependents. Now, this may be you, it may be your in-laws, it could be your sons and daughters with their young children. So something you want to share with them if they happen not to be on this webinar today. The new tax law doubles the old child tax credit from $1,000 to $2,000 per child per children under the age of 17. So that's a doubling of that. That's great. The new tax law also increases the refundable portion of the tax credit to $1,400. In some instances, this would allow a family to receive a refund even if their net tax liability is 0. Something else to discuss with your financial tax professional. The new law increases the income threshold for qualifying for the child tax credit, so this credit will now be available to more families. It's one of the reasons this law has some nice provisions in it for those with children. Also, the new law will allow certain taxpayers with an additional non-refundable credit if they have non-child dependents who they are supporting who are age 17 or older. This credit is $500 per dependent. Moving on, number 4. the alternative minimum tax, or known as the AMT. The fourth thing to know about the new tax law involves a term that most people have heard but probably don't know a lot about, which is the alternative minimum tax, or the AMT, not to be confused with the ATM. The AMT was initially put in place in the early 1970s to prevent wealthier taxpayers from using excessive deductions to minimize their taxes. During the legislative process, there was much discussion about eliminating the AMT. However, the final law keeps the individual AMT but increases the income exemption levels and phase-outs for the AMT, so it will likely impact fewer taxpayers. Now, I don't know who was on the webinar that this may apply to, but once again, this is an overview of the new tax law. Number 5, estate taxes. The fifth thing to know about the changes to the federal estate taxes are the exemption amounts have increased substantially. In 2017, the federal estate exemption amounts were $5.49 million per individual and $10.98 million per married couple. Under the new law, the exemption amounts have increased to $11.2 million per individual and $22.4 million per married couple. So substantial changes there as well. The estate tax rate for assets that are under the estate let me try that again. The estate tax rate for assets that are subject to the federal tax have remained largely uncapped and capped out at 40% for 2018. So you can tell this is live, folks. The tax rates will not change, capping out at 40% for 2018. Moving on to our next and last number, corporate taxes, number 6. The new tax bill, the sixth and final thing to remember about the new tax laws. Oh, God. I gotta go back and I'll edit this. Number 4, the alternative minimum tax. The fourth thing to know about the new tax law involves a term that most people have heard but probably don't know a lot about, which is the alternative minimum tax, or the AMT. The AMT was initially put in place in the early 1970s to prevent wealthier taxpayers from using excessive deductions to minimize their taxes. During the legislative process, there was much discussion about eliminating the AMT. However, the final tax law keeps the individual AMT but increases the income exempt levels and phase-outs for the AMT, so it will likely impact fewer taxpayers. Number 5, estate taxes. The fifth thing to know about the new tax law are the changes to the federal estate tax. The new law keeps the federal estate tax in place. However, the exemption amounts have increased substantially. In 2017, the federal estate tax exemption amounts were $5.49 million per individual and $10.98 million per married couple. Under the new tax law, the exemption amounts have increased to $11.2 million per individual and $22.4 million per married couple. So a substantial increase there. The estate tax rate for assets that are subject to the federal estate tax have remained largely unchanged and cap out at 40% for 2018. And number 6, our final talking point, corporate taxes. Under the new tax law, the corporate tax rate was reduced substantially. Previously, the corporate tax rate ranged at about 15 to 39%. Under the new law, the corporate tax rate is a flat 21%, and many stockholders should expect to receive larger dividend checks in the near future. These unexpected funds will open up more options to reinvest in the retirement plans, which, like most budgets, are usually underfunded. We always encourage you to look at how you can address one of the greatest fears that people have when they move into the retirement world, the distribution phase of their life, of the assets that they saved, to make sure their money lasts as long as they do. The number one fear in America for baby boomers is running out of money. So this is going to be something that is going to be helpful for that, and something that you want to take a look at, because it could be very beneficial to do something with these unexpected funds rather than just spend them on things that aren't as important as longevity of your livelihood. I mean, most people spend more time planning a vacation than they do on planning their retirement. So just that you're on this webinar shows me that you are interested in minimizing your taxation as much as possible, certainly learning about it, and taking a more careful look at what your retirement looks like. But another sweeping change are the new law to smaller businesses that utilize pass-through income. There are new smaller businesses that usually moving on to our final item, number 6, corporate taxes. Under the new law, the corporate tax rate was reduced substantially. Previously, the corporate tax range ranged from 15 to 39%. Under the new law, the corporate tax rate is a flat 21%. So the result is many stockholders should expect to receive larger dividend checks in the near future. These unexpected funds will open up more options to reinvest into plans for retirement, which, like most budgets, are usually underfunded. Most people spend more time planning a vacation than they ever do looking at their retirement plans, and when you know that the number one fear in America is the fear of running out of money in the baby boomer sector, that this is an important thing to think about. So some extra funds that may be coming your way, they might be best allocated or reallocated towards something that's going to help you sustain a quality of life throughout your retirement and plan for the things that could happen as a result of aging. Additionally, the corporate alternative minimum tax is eliminated under the new law. The AMT is eliminated under the new law. Another sweeping change under the new law applies to smaller businesses that utilize pass-through income. These are smaller businesses that usually organize as sole proprietorships, partnerships, S-corps, or LLCs. Under the new law, some pass-through entities may have the ability to deduct up to 20% of their qualified business income. This deduction was not previously available. Some of the changes may not fully apply to certain types of businesses involved in service industries. 20% qualified deduction. This is something you definitely want to talk to your tax professional about, how you can utilize this. This change is set to expire at the end of 2025. Definitely something to note. Once again, the reason for this tax law, a big part of this reason, the goal was to spur economic expansion through the creation of new jobs and capital expenditures. We live in a global economy. You've seen what's happened to the market since the beginning of the year. We've had over 80 corrections since January 1st of 2018. We all lived through the 2002s and the 2008s and know what that means. So, hopefully this will be something in the right direction, but corrections in the market certainly are not just going to be on the horizon, they are already here. So, think about what you can do with these dividends that may come from this corporate tax reduction. Other things to note: there are no changes to the capital gains tax rates in the new tax bill. There is no longer a penalty for individuals that choose not to purchase health insurance beginning in 2019. So that provision under the ACA or Obamacare, as most people know it by, will not be a penalty for not having health insurance starting 2019. And student loan interest and charitable contributions deductions remain intact. So in review, we talked about personal income tax brackets, personal deduction changes, child tax credits, alternative minimum tax, estate taxes, and corporate taxes. This is just an overview of what we will go into in greater depth in our next series, Part 2, Found Money. The reason we call it Found Money is because if there's anything you can do to save taxation, sometimes what you can save outperforms what you earn from an investment vantage point. Saving money is just as important as earning money, particularly when you are hoping to establish your livelihood from the distribution phase of all the assets that you've saved throughout your entire life, when you change that transition from accumulation to distribution. So these are some things that are going to help you. If you're looking for a second opinion to make sure you're in line with this and you have some questions, we can certainly help you with that. So this next workshop is going to go deeper into examining what your 1040 form looks like, some of the things in the tax law, current tax law and past tax law that you may not be aware of, and you may have not even been able to take advantage of because you weren't aware of them through many, many years. We're going to make you aware so you can take that back to your tax professional and get some help with that. But if you're curious about your overall plan, how this factors in with everything that has to go within your retirement plan, so to speak, this is a good opportunity. And remember, you can't get a second opinion from the person who gave you the first one. So, based upon that, part of what I am here to do is to help you get a second opinion on where you're at with your plan if you actually have one. If you don't have a plan, that's an excellent reason for us to talk as well and see what we can help you figure out. This concludes this part of the webinar. I do want to add that we have resources available on our website. We have an a brand new website, done a major overhaul, made it very simple for you to navigate and find the areas of interest. Works very well on your iPad or your phone as well. Broken down to 6 major categories. Makes it very easy to navigate, so we invite you to check that out. Also, we have a monthly newsletter that we distribute as well, so you can take advantage of that. You can also look at past newsletters on the website. We have close to 50 articles and blogs now addressing all areas of retirement and insurance and health and Medicare and Social Security needs and questions. And we also designed something we call the Retirement Toolbox. Retirement Toolbox is free access for anyone on this call here today. And all you have to do is go to the website, or we will send you a follow-up email to this webinar anyway. There will be a link in there for you. And there you can find information and detail of all these different things we discussed and touched on having to do with retirement planning, and also lots of video content, reports and guides and charts and so on. So I recommend that you have a look at that. In conclusion, this is part one of part 2 of tax reform. We will be letting you know in the next week or so when our next webinar will be. We'll be doing live workshops as well. We have a live workshop coming up May 10th at 6:30 in Laguna Niguel at the Sea Country Community Center, talking about Social Security and income planning. A combination. This is a brand new workshop, different from what I've done before, and going into a lot more detail than I've done before in some of these other areas as well, incorporating Social Security income planning. So if you'd like to attend that, once again, that's free to attend as well. But we will be doing many more webinars and rolling them out in the next several months. If you'd like to contact me directly with any of your questions or concerns or comments, you have my contact information here on the screen. And like I said, you will also receive an email follow-up. And once again, we thank you for your time. We hope this was beneficial for you, and we look forward to speaking with you soon. And we got it all done under 20 minutes. Take care.